So our goal today is that you leave here with a better understanding of investing in real estate and the different places to invest in real estate. So our distinguished panel, I'm going to have each of them introduce themselves and do kind of an elevator speech. So Damian McKinney sold his brokerage business to Avis & Young in late 2019 and now runs both that group in San Diego County and McKinney Capital. So Damian, can you give us your elevator speech?
All right, so everything we do is real estate based. On the advisory side, it's the Avis & Young, and it's part of it. It's $1 billion full service corporate real estate firm. And so we now run the San Diego division of that. And so we do corporate real estate services. The other is McKinney Capital. And McKinney Capital is really an opportunity fund where we go out and buy different asset classes of real estate, typically a good discount, and then stabilize those assets for either long-term cash flow or flip for a good IRR.
So next is Chris Robinson, who's the president principal of Acre Investment Real Estate Group. So Chris, if you could tell me what you do.
Apartment broker by trade, so kind of a specialization of representing sellers in the marketplace. I've kind of tried and true San Diego guy, so the focus is really San Diego property. 5 to say 50 units is our wheelhouse, and it's a lot of our value is kind of strategically helping somebody go from point A to point B on a lot of 1031 exchanges. So brokerage by trade, and then over the years, I'm just a big fan of cash flow. So about probably 07 was the first deal I bought. I was making my clients so much money that I just figured, at some point I want to get in and own this stuff myself. So from 07 to today and moving forward, I've kind of created my own portfolio, and that's what I've been maintaining on the side. And the Apartment Geek is something that I'm real proud of. It's kind of this fun, started off as just a marketing angle for me to get more listings really for apartment complexes. And it's turned into something that I really like, which is kind of this educational giving back and helping people see how they can create some financial freedom through buying apartment buildings. So that's my deal.
Thank you, Chris. And Chris Russell, Managing Director of Mercatus Partners, and Mercatus is the real estate investment arm of Andina Family Offices. So if you could introduce yourself.
Sure. Yeah, so Mercatus Partners, like you said, we're affiliated with Eric over here at Andina Family Offices. So we are, a small private real estate investment group that focuses primarily on multifamily and institutional. We basically just manage real estate investments for the family office clients. We are focused on probably four or five markets primarily, and buying, building. We do direct deals, and we also work with some really high quality sponsorship. So our markets are San Diego, Salt Lake City, Nashville, Tennessee, and Raleigh, North Carolina. We are primarily looking for markets where we see the most growth over the next 10 to 15 years. Looking for properties, we want to find properties in great locations, well built, not top of the market, but quality product that's not going to have a lot of capex issues, and where we see a lot of growth kind of going forward. So, yeah, I think that's probably
good.
That's probably it.
Thank you. And then last but never least, so Nick Davison, President of Sterling Investment Group.
Hi guys, I'm Nick Davison. I've got a residential company here in town. I've flipped about 500 houses myself with a small team of people. We also buy small apartment buildings in San Diego, 5 to 50 units. We've done syndications just as McKinney is, I'm sure everyone else has. And we also do coaching and showing anybody that wants to flip houses. And that's it.
Good, so I asked each of them versus me trying to figure out what questions to ask people. I know I have my interests, but I think the best people to ask the questions are the people that have the information. So I asked them each to submit to me questions that I should ask them. And I'm gonna have Nick go first. And so the first question Nick asked was, how good looking are you on a scale from 9 to 10?
9 to 10.
I swear to God,
That's true.
this is Nick's first question.
But you asked, and I have to answer.
So I asked my wife, I took a picture.
Oh yeah. What'd she say?
No comment.
Definitely not. Definitely.
Solid 6.
Yeah.
I love you.
So anyways, the real question, what are you most passionate about right now in your business?
I'm honestly most passionate about the coaching stuff we're doing. There's a lot of companies out there that are teaching people how to flip houses and get into real estate. And they're just not doing that good of a job. We are taking coaching students one by one, and we're showing them how to do, invest in real estate. I had a lot of losses at the beginning of my career, and those are painful, as we all know. And we just have some really good success stories of some people, guys that have had broker licenses for over a year and couldn't find a good deal, didn't know how to do it. And these guys, within like their first 45 days, they're finding properties, we're showing them what to look for, we're helping them underwrite, we're just hand-holding them through the process, and they're supposed to make some awesome profits, and I'm most excited about that.
Great, thank you. Chris Robinson, why apartments?
So, I like this question. If I'm gonna own something, I wanna own something that somebody really needs. And I've always thought about needs on kind of a spectrum. And just basic survival stuff. You need water, you need food, and you need shelter. And being in this for 18 years, I've seen a lot of retail, industrial, office. And if there is issues with finances or there's a recession, people need a place to live. And I just believe in the fundamentals of multifamily. Then if you can go a little bit further on the spectrum of like A class, which would be downtown, where people have more options. Maybe they go move in with their parents if they have financial distress. I like the lower income stuff, so call it like B to C, low to middle, because if they're not paying their rent, they're typically on the streets or living in their car or figuring something out. So if we have a late paying tenant, it's usually something that's mitigated within days. And in owning real estate for 13 years, I've had 2 evictions only. So
Good record.
yeah,
So
that's why I like it.
Damien, next is for you, and what kind of investments at Capital do you focus on?
We like to focus on really 3 buckets right now, and it varies over depending on where the economy is. But right now we're in hospitality, multifamily, and more specifically workforce housing, and we like industrial. So those are our 3 categories that we find the best opportunities for us.
And one thing, this is, as I know information, so Chris has sold a number of buildings to a good friend of mine who's gotten very involved in the apartment business, and that's how I heard about you. Damien has done some interesting things, one of which is a hotel in Catalina.
In Catalina. Yeah.
So it's really interesting sometimes when you think of real estate, a hotel in Catalina. How many of you have gone to Catalina and tried to get a hotel room? Near impossible when you try and go there, especially if you take a group, because I used to take my company over there once a year, and it's tough to get you have to work around the availability. So it's been an interesting investment for you. So Chris Russell, your target markets are spread across a very wide geographical area. What do you look at to determine where you're going to go?
So our primary focus right now is we're looking at some pretty significant demographic trends. You've got population migrating out of the high-cost coastal markets, the Bay Area, New York City, Boston, Chicago, migrating into lower-cost markets, higher quality of living, lower regulatory, lower tax. It's a pretty significant transition. So we're looking for markets that are the beneficiaries of that migration. Salt Lake City, you've got a lot of people coming from California. Charlotte, North Carolina.
From California.
You've got a lot of people coming from California.
Nashville from California.
So New York City is like, if you're in New York City and you want to find a little bit cheaper place to live, Charlotte's kind of where you go. Chicago or Nashville's the same thing for Chicago. So as the state governments continue to push businesses and population out of these states, we want to be in the markets that are going to kind of welcome them with open arms.
So this is not on script. I'm going to go totally off script, which I do pretty regularly. So filled out my voting things yesterday, which many of you are going to go vote. What effect do you feel? Well, I'll ask you this in two ways. Is it Prop 13, the new commercial real estate tax, or what's it
Prop
called?
13 is what's protected. The property taxes are kept.
Okay. So how about the new thing we're voting on for commercial real estate? Is that something that?
There's rent control, which
Okay.
I don't know if that's what you're referring to.
Yeah.
I don't know.
Is
So
there
with the
rent-
split roll where your commercial real estate assets can adjust, the property taxes can go up by 1%.
Yeah. What's that one called?
I don't know what the profit is.
Okay. Is anyone-
Yeah,
is it-
they're
is it
trying to get
Prop-
away. Yeah, split tax
Trying to
roll.
blow out
Yeah,
Prop
they're calling it.
13.
So is that going to affect us in this next election at all, or?
What is the
For
issue?
over 4 units.
So as you guys know, if you're homeowners in California, you are, the state of California can't increase your property taxes, or your county can't increase your property taxes by more than 2% in a year. They're talking about having a split roll. So now that's going to stay the same for residential, but commercial property taxes can adjust by more than 2%. So
And
places-
multifamily.
and multifamily. So
Good.
I think-
Multifamily over 5?
No,
Yeah.
over
I heard
4.
multifamily was exempt,
No,
but I don't really.
I think it's over 4.
Yeah.
So that could.
So anyway, I just want you to be aware of things that are trying to get on ballots, and I know my wife and I call our congressmen and
Let's find
senators
out.
and assemblymen all the time.
Well, we're the experts and we don't know, so that's
Yeah.
good news.
You
guys.
need to be educated on these issues, because if these things happen, what happens to rents? They're talking about it'll help everybody, but what happens to rents if you have higher taxes on your commercial properties?
devastating.
Rents go through the roof. It would absolutely be the reverse of what they're trying to accomplish.
Isn't there some new rule that rents could only be increased up till February or January of this year, and then going forward, it can only be adjusted so much for inflation?
Yeah,
Rent
it's
control.
5% plus inflation.
Which is
So-
2.2.
Exactly.
Okay.
So you can raise the rent 7.2. That was this last 12-month period, and then it resets. I think in April, they reset the inflation amount. Pretty sure.
The workaround.
And that's adjusted every year.
People sign 11-month leases.
Yeah. Yep. That's what some landlords.
So
are
I'm
doing.
sorry I took us off the reservations. My only commentary is you need to be aware of what's going on in our government to be able to either help or assist or stop things that could be not beneficial. So, Nick, I'm going to have you. What do you do every day? This is a serious question.
Okay.
So not.
Oh, well, okay.
Yeah.
I
Okay.
thought you were giving me a look like, give me something funny.
No.
Sure. I just hired a new COO, so I'm stepping away from a lot of the operations in the business. Really, I've got a lot of extra free time, so I'm spending a lot of time with coaching stuff.
Okay. And then when you went out and bought these properties, who goes and finds them, that type of thing?
Back in the day, I would do everything from A to Z, and then now I have a team. I have a project manager that goes out and inspects the property condition, an asset manager that overlooks the numbers, a property manager that looks at the rent rolls, etc. And any and all contractors, we need to go out and do the inspections, but I don't really go out as much these days. And if I do, it's because I'm bored.
Okay, good. So you don't mess it up now.
No, yeah, it's not messed up now.
So, Chris Robinson, what should someone focus on if they haven't bought their first deal? What are the things they should focus on?
Well, barrier of entry is difficult because apartment buildings are expensive. So just saving the money is tricky. You've got to have a down payment after tax, which is $300,000-400 grand. One little tip that I really like is to try to find an owner of a 4, 5, 6 plex or 10-unit building, whatever it is, who's going to carry the financing. So seller financing. That's how myself and some other investors I know have really kind of pounced and taken leaps of progress early on by getting a higher loan to value so they can go in with 10, 15, 20% down payment and control the real estate. Otherwise, you gotta be doing big, you gotta have a sales job where you're making 500, 600, 700 grand a year or whatever. If you're W-2, you better be, a doctor or an attorney. It's tough. Yeah.
2 questions. What is the advantage to the owner? How do you get them to see the value in that? And
Seller financing?
Carrying the financing.
Yeah,
And the
that's
second question is, how do you get the apartment building to cash flow appropriately when you're only putting 10%?
So the first question, so how is it a benefit to the owner to carry paper? It's going to be a tax strategy for them. So if they sell the asset, usually they're going to pay tax on the entire amount. With the seller financing, it's only taxed on the down payment. So if you give an owner 20%, that they're going to pay their capital gains on that. They can then maintain cash flow for the term of the note, which for a lot of people who are older and kind of creatures of habit, they get nervous or scared if they get this big chunk of money. It's almost like they don't know what they're going to do with it. So this way, they're out of the management and they're making 3, 4, 5 grand a month, whatever it is, the interest. And I've seen a lot of cases where that amount is more, believe it or not, than what they were making as the owner of the property, because their management was so wacko or the rents were so low. Second question is going to be, you've got to find something where the cap rate's high enough than what your interest rate is. So if a cap rate on an apartment complex where you're buying it based on the price is 6%, so I'll call it 5%, and you're borrowing money at 4%, there should be some arbitrage there. And if the LTV is big enough, you're going to actually, that arbitrage is going to create a bigger cash-on-cash return. If you kind of go through all the expenses and down to your net cash flow. So it's just a function of like pricing, having the right price on the property.
Let me add to that real quick. It's also because we just did this with seller financing. They also have to take that money and then go find a new investment to put that money into. But they already own that property for maybe 10 years. They know it. They know everything about it. So you come in there, you give them, 30% down. And if you don't pay them, they foreclose and get a property back that they already fully know. So they don't need to go out there and find and do their due diligence on a new investment, whether it be stocks, bonds, another piece of real estate. So it's another good point.
It's kind of a retirement strategy for them.
Yeah.
Seller carry 5-6 cap rate, sold sight unseen. I'm your guy.
Right? Yeah. They're hard to find.
Okay, so let's bring it back.
You've got to pitch it to the owner. You've got to say, hey, would you carry financing?
So I'm an example of that, just so you know. My first home that I bought, which was 100 years ago, but it was in a depressed market. The owner wanted to sell it. They were an older couple. My wife and I put 5% down. The owner carried 5% back. By the way, the interest rates were 18.2%. Jimmy Carter helped us tremendously with our economy. 18.2%, 5%. I think the owner was hoping we didn't come up with the other 5% down, in the year, because they would have taken it back.
Yeah.
But we didn't lose it.
Just to finish that real quick, Joe. I think in holistically what I'm thinking right now is like, if you want to get in the business, be creative, think outside the box. Otherwise, you better have a ton of money saved up.
And by the way, there's a great book. Go ahead.
I was just saying, Eric said something that's kind of interesting too, is if you're an investor, or if you're an owner, a property owner, it's hard to get returns. A lot of times in like a bond market, something conservative and safe.
That 10-year bond's at 1.5.
Yeah, so I mean, if you can
Yeah.
get someone to give you 30% money down, cash flow it, and get a return, it's a lot of people like that.
Yeah.
There's a lot of people here other than our banks that would love to lend you money on these kind of transactions. So
There's a lot of groups out there too that will do syndications for properties, so you can get involved with one of them. There are several in San Diego where you get on their list, and every time they get a property under contract, they're going to blast out a proposal to all their investors, and you can participate that way. You can participate at whatever level you want to. A lot of times the minimum is be $50,000. So that's another way to get involved.
That's true.
So, Damien, what do you see ahead for the real estate market? So we're seeing, you know, the stock market is going through its gyrations right now. Has had a great run. There's a run projected ahead, I think, Eric, is what we would see, I hope. But what do you see for the real estate market?
Well, this is an interesting year to ask that question. First of all, real estate investors typically think longer term than the stock market. Certainly a day trader.
They shouldn't, but that's true.
Yeah. So I think what this year, it really depends on outcome of an election this year and where interest rates will be, where the economy may be. But if you just say things are going to stay stable and policy procedures that are in place today remain the same, I think the real estate market is a very strong, healthy market to get into. There's going to be even more lift, which seems hard to believe because we're at record high valuations today. But where the economy will lift that and real estate values will go with that increase, I think we've got another plenty of time on the horizon, 5 years or more, that the economy will lift the real estate market. So rents are going to continue to climb. And if you're an institutional buyer that buys at a 5 cap, then you're going to see appreciation in rents to create value for you over time. If you're a value add player, it's very difficult to find good opportunities right now. They're out there, but they're much more difficult to find those motivated sellers. You may have to go to secondary and tertiary markets, which are actually a pretty good play right now.
So, Chris Russell, where do you see the biggest upside in the real estate investment over the next 5 years, and where do you see the most risk?
So I guess I'll start with risk first. I see a lot of risk in the value add space. Guys are pushing out, so people are chasing yield. Guys that have historically invested in real estate are expecting a certain type of cash return and an overall return, and they're just not getting it anymore. So in the markets that they've historically invested in, so guys are getting pushed out, or groups are getting pushed out into secondary, tertiary locations. And so the way we see it, historically, you look at places that are Las Cruces, New Mexico. An apartment complex in Las Cruces should probably trade at an 8 cap. But right now, you're probably buying it maybe a 5.5. And the fear we have in the market, and we're seeing a lot of our competitors move into places like that, where if cap rates have gone from 9 to 5.5 over the past few years, if there's a correction in the economy, they're going to go from 5.5 back to 9. So we see a lot of risk there. We also see a lot of risk in the in the gateway cities, so probably the top 5 cities in the U.S. Building high-rise, super close in, places like New York City, San Francisco, Seattle, where there's been a ton of supply. And there have been the jobs over the past 10 years, there have been the jobs to back it up. But as soon as this
is when we sit in forum meetings, is a lot of our members have primary businesses, but they want to invest in things like real estate. And they go, where do we go to place money that we can get a safe return? And there's a lot of capital sitting on the sidelines. Yes, sir.
Can I connect to that? I have a business owner that has an office building, and I use the word office building in a very loose term because from the street it looks more like an apartment building than an office building in Old Town. And they've been told they could convert it to 10 to 12 units. Their office is there, and they would relocate, but I'm the one that gets the call for that. And so we bill ourselves as consultative banking, so that's not unusual. So I called up a broker that I know and offered this solution, and they referred me to a well-known consultant in town that everybody in here would know. But I know that this is going to be, the price he's going to charge is going to be way over what she would cut a check for out the box. So I'm thinking that a savvy broker that would look at this would come in and do some consultation like I do, understanding that they're going to be the one that controls this and see the commission involved. Are you guys, is that interesting to you, or do you know someone that would help with that?
I'm interested in that, everything you're saying.
How many of you are interested in that? up here.
Yeah, I think we all do broker of opinion values. That's pretty common now because appraisers are backlogged and they're expensive, so those appraisers call us for the information.
We have an appraisal in the front yard, front of the road here.
Yeah, and I think repurposing repurposing office buildings for something of higher value at the end of the day is huge, especially in Old Town, where your rents are gonna be.
Looked like a winner to me.
Yeah.
I wouldn't have referred it to that consultant.
That sounds real interesting.
So, and by the way, the consultants who we all know are really good, but they are expensive.
Yeah.
I saw the ticket for, the $100,000 ticket for.
I would say if it was a project 4 times this size, I would bring that guy in, but not.
Again, remember, right now it's a great economy.
Exactly.
Everybody's busy. Everybody has too much business in every category. So what we are finding is everything's a bit above market, but there's also a ton of capital sitting on the sidelines waiting to invest in both companies, real estate, and other things. So I'm going to bring us back to Nick. So Nick, let's pretend you're 18 years old again.
All right.
Kicked out of school, which I know
Yep.
you and me. There's 2 of us that happen to.
Gotta go.
So how would you do it all over again? If you were starting over in your real estate career, what would you do differently?
I'd probably follow McKinney. Just keep it. I mean, I did a lot of it with the School of Hard Knocks, and I read a lot of books. But honestly, if I would have just went and worked for a guy like him, or found a coach that has been doing this for a lot longer than I have, I would have just, it's the same thing with all you guys' business. If I was to go in your business and I were to say, I'm going to do it on my own, opposed to paying you a fee to just teach me how to do it, the answer is pretty clear.
So get good coaches, learn from the best.
Yeah, good coaches, and I mean, for the real estate sector, I'd probably understand and learn the market cycles better.
Okay.
So in the 500 properties that I flipped, I could have probably done 1,300 properties. Every year I gave up, I probably flipped about 50 properties a year, 75 properties a year. I could have done double that. I was just very nervous of the market. I didn't understand it. And so for the last 4 years, I think we're all thinking, boy, it's about to go. So I shouldn't, don't get too risky. So, you live and you learn, but those are the 2 things. Get a good coach and then probably understand the market cycles.
So Nick, I have that question for you,
Yep.
and this is being videotaped by your people.
Bring
Is it about to go?
What do you think, guys? Honestly, I don't know, but I'm buying everything as if it is. So that's how I.
So you pretend it's going to go.
Yeah, I pretend it's going to go.
This
Right. So when I'm buying these apartment buildings, I'm stress testing them. The rents will drop 25%. That's a big number, but I don't want to lose. And I've lost before, and that hurts. So
Plan for the worst, hope for the best, right?
exactly.
So just to give you all some flavor, so 30 years ago, I invested in a local company called Con Am. Has anyone ever heard of that? They own a couple apartments across the United States, and last year, Con Am converted all of its properties for the benefit of the owner, the primary ownership. It will never be sold.
Oh,
Well, all of their properties, we all got a letter saying, the majority of shareholders voted, one guy. And it's all going to be 1031 exchange now. That's the only way we'll sell a property. So you're in for life, in effect. So it's interesting how, now they have a new fund, which is different, but that's the old one. So Chris, if I'm a buy and hold person, how do you know when to sell a property or do a 1031 exchange? First of all, does anyone, it's okay to say it, do any of you not know what a 1031 exchange is? Okay, could you explain what a 1031 exchange is quickly?
yeah. So 1031 exchange allows you to sell a property where you've had gain on it and defer the tax if you complete an exchange, which means you sell that asset and then you go purchase another one within a certain amount of time. And there's some rules to it, which if you want details after we can chat. And if you do it the right way, all your gain tax is deferred basically forever unless you sell. So it's a huge advantage for apartment owners who are expanding.
So a lot of families, like we don't have children, so it's like, hey, sell it, we'll take the profits. But a lot of families with multiple generations, they're buying these properties for the great-grandchildren. And so they want to do this time immemorial, right? They want to roll it generation to generation and just have it pass through. Whereas other people want to make money. But what I would say is, any of you would say is, don't go into real estate investing if you want to make money in 30 days or 60 days. Look at it longer term. Is that a fair statement?
Yeah, absolutely.
Nick, unless you're
Do
Nick.
Yeah,
do
and that's contrary to Nick, which,
Yeah.
you know, I know you're more in and out of
Sure.
deals.
Yeah.
But there's a place for both.
Yeah,
right?
totally.
Yeah.
Absolutely.
So,
Yeah.
Damien, what has been your most successful investment strategy? Because you're the godfather of.
Well, I always start with the end in mind, and I also start with the concept, you make your money when you buy. You don't count on the market to create the value for you. You have to make it when you buy. So I always look for motivated sellers. I actually, in my due diligence, the most important part of my due diligence is having a cup of coffee with the seller to see if they're motivated or not, if I can buy right. And of course, it's a process. You have to be disciplined in how you buy. But we buy assets all over the country in markets that we knew nothing about when I got the phone call. Yet we made really good investments in those markets because I found a motivated seller, and I knew what the end game was when we went into it. And so when you start with the end in mind and you start with the discipline of buying right and making sure your due diligence is thorough, then your probability of success goes way up. And so that's really, in a very generic response, that's the formula.
Yeah.
Chris Russell, a lot of people are talking about defensive investments in real estate. I think part of that is the economic cycle, and a lot of economists, don't know what's going to happen in the election. Let's pretend we all think we know what's going to happen, right? But we really don't know. All of us prognosticators thought the last president was going to be Hillary, correct? I think that was what all the pundits said. Well, all the pundits right now are saying it's going to be, probably the same person that's in office now. But what happens if there's political upheaval? Any feeling on that? Or political change?
Yeah, so I think that it's hard to say that Democrat presidents have been bad for real estate or Republicans have been good, or vice versa. We did great under Obama, and we've done great under Trump. So I don't know if that's always going to remain that way, but our feeling is we were of the mind in end of 2018, beginning of 19, that there was a recession potentially coming pretty quick as the Federal Reserve was hiking interest rates. The stock market was declining pretty rapidly, and because of the fact that didn't happen, it looks like the market stabilized pretty substantially, and we don't see anything on the horizon that's going to throw that off. One of the things that we do is we keep close tabs on some very reputable short sellers, some market bears, and we'll podcast, newsletters, and what we're doing is we're looking for trends. In 2007, if you were listening to these guys, you heard a lot of guys saying the same thing about here's the risk. We see collateralized mortgage applications, all this stuff. And when you start hearing across the spectrum, these guys start to be concerned about the same thing, and you got some potential issues. And in late 2018, early 2019, that was what people were talking about. So right now, it looks like, basically from everything we're seeing, is that in the near term, there's not really anything we can point to that's saying there's a lot of risk here. But we still want to be defensive because of the fact that we are in the 10th year of this business and real estate cycle. So we're buying high quality real estate in good locations, staying away from the very top of the market, and also trying, like I mentioned before, trying not to chase yield. So it's a strategy that's done well for us in the past, and we'll continue to pursue it. But buying a little higher quality and building a little higher quality now than we were 7 years ago. When you're early in the cycle, it makes a little more sense to take a little more risk. We're just dialing back the risk a little bit, dialing back our leverage a little bit. We early in the cycle, 75% was not abnormal. We're really focused on debt service coverage right now. So how many times can we cover our debt payment every month? So what I did an analysis is if your debt service coverage in your on an amortizing basis was 1.35, meaning you cover your debt payment 1.35 times, your rents could drop by more than 20%, occupancy by 5%, and you'd still be able to pay your bills, your debt. So the thing we're trying to avoid more than anything is having to give a property back to the bank, because long term, the market's going to come back. If we can just kind of weather the storm, we'll be all right. So that's what we're looking at. We're looking at defensive locations, defensive markets, where we think the most upside is, with limited downside over the next 10 years, and then just being very cautious with our leverage points.
So I hear, Tim, you had a question.
Yeah, can I ask?
Please,
one?
please.
I don't know if this is in Nick and Chris's wheelhouse, but I'm on. Anybody else on that app next door?
Yeah.
It's like, you hear everything in your neighborhood. So one thing that I've seen a lot on is about SB 1069, AB 680, SB 330, and SB 50 that got turned down. And basically what those are is in single-family lots in California, you can basically now convert. You can put a granny flat on your house. Now they're letting you put a junior flat on your house, so you can get 2 flats on a house. You can convert you don't have to have parking spaces in your lot. And SB 50 just got turned down, which I bet in the next year will modify and get approved, which means you can take a house lot and turn it into a 4-plex anywhere. So it could be your next door neighbor's house. That someone comes in. So are you guys starting to look at real estate differently? Like where there's lots of parking spaces, let's say there's a 4-unit with 12 parking spaces, it now could be, I'm making this up, a 16-unit, because you don't have to supply parking. The whole idea is creating more affordable, dense housing, where they don't care about parking, where people are taking Uber, taking public transportation. So that's the question is, are you all of a sudden looking at properties different now, where maybe single family properties can become apartment complexes, or 4-plexes can become 8-plexes?
This is a reminder for me to start doing this right this minute. Because no, seriously,
Absolutely.
I've heard people doing this within within the last week or two. I was at a lunch with a banker who has a client who's been doing this through in the Linda Vista area on USD.
So if you look at land, the value of land changes.
Yeah.
And you can put more doors on it.
100%.
And so it may be actually undervalued now because of people aren't aware of it or don't have it.
Yeah, you've got to have the right size lot, and then you've got to go to the city, and there's still going to probably be some brain damage there. But the city's making it a lot easier for you to do those kind of things.
Some of them are even subsidized. You can do it for free.
So Damien, you're up
Yeah.
next, and then Nick. Yep.
So, Tim, that's a great question. It's a great opportunity for all of us to get into. We actually have an offshore fund that's asked us to put $100 million into that industry. ADUs, we call them, additional dwelling units. So we're looking at certain markets throughout Southern California right now, and where we're looking at going into areas that have, the lots are larger than what they have been over the last 30 years. When you look at homes that were built in the 50s, 60s, and 70s, they were typically homes with yards, and compared to what we see today in the last 30 years. So we've gone into those neighborhoods, empowered brokers to go out and really start searching. But there's already a groundswell of other buyers looking for those markets, in those markets. And so we're looking at teaming up with not just capital that wants to invest, but how do we build our units for less than the competition? So prefab units is what we've teamed up with, a manufacturer of prefab units who wants to get in the business, and they're the ones that have asked us if we actually commit to $100 million of their capital to go into those markets. So it's going to really change the dynamics of the residential market, especially single family dwellings.
Nick, you're up next.
So I'm currently doing this on 2 properties right now, on a 14-unit building I have and a 12-unit building. The 12-unit building has these garages, and they're probably about 100 square feet, 200 square feet each. And normally the biggest thing that was holding us back from converting those to legal permitted units was the parking. So we just found out that we can convert those garages into actual living spaces. We also did that on a 14-unit that I own, and there was a front portion of the building that was literally 200 square feet. And so we didn't think much of it, but as we dug and like Chris said, it's a lot of brain damage of working with the city to get that approved. But that turned into an additional $1,300 a month for like 200 square feet. And so that extra income can yield you a couple $100,000 easily.
Yeah.
Another strategy I've heard people doing is if you think about, let's say you have 6 or 8 spaces.
Yep.
That you don't necessarily have to put the capital to renovate the building, but what's going to start happening is spaces are going to become a premium, and you can start charging more for spaces because it's all these buildings. It's already hard to find parking. I see that everywhere on the beach. You can now elevate that, put that into your equations, or just again, if you don't want to invest immediately in the building, those spaces become a lot more valuable.
Yeah, with rent control from around the corner, you're just getting that much more creative with any other ways you can find extra income. $25 a month, $50 a month on a unit here and there, it adds up.
Or billing the tenants for their portion of utilities.
Right, totally rubs.
By the way, one thing I've been educated on lately is, we hear rent control and everybody goes, oh, I guess I'm not going to invest in real estate anymore. There's an infamous guy in LA who used to own a basketball team who made, and David, I think you bought your first property from this guy.
Early in my
So, infamous guy, owns a basketball team, his name's not Bus, and he made his money when rent control hit LA. That's when he made his wealth. So, during times of change, there are opportunities, and be aware of that. You don't run away from times of change. Any feelings on this?
Yeah, so it's very true. So what happens with rent controlled units, and you see this a lot in places like San Francisco and Oakland, is you're going to get a segment of your renter pool is going to stay in their units for years and years. So what we found in our analysis, it's about 30%. But what happens also with rent control is it discourages new development. So now there's fewer developers coming in to supply new units. So there's an imbalance in supply and demand. There's not enough new units for the number of new renters. So those rents on the 30 units, you can't push them more than whatever the allowable amount is, 2% in some areas. But for the remaining units that are turning over, the remaining 6-7% of your units, because there's not a lot of new supply to compete with, your rents are going to go up even faster. So you look at some of the markets that have had rent control the longest, New York City, San Francisco,
It's
Oakland.
cheap to live in those.
It's very cheap, yeah. So that's the key. So what we look at is we see in markets where the government involves themselves most in the process of building or kind of renting apartments or just housing in general. It's very cumbersome and it's a pain to deal with. But that's where we see rents rising the fastest. That's where we see values rising the fastest. So it's scary, especially when you own an apartment complex in a place like San Diego, and now you know that you're not going to be able to raise rents by more than 7% or so in a year, and maybe the state will bring it down to 3% or 2%, like different cities have done. But that's only going to be for a portion of your renters because of the fact that a lot of people, at some point, they want to get out of an apartment, so they move to a house. So you're going to have churn on a lot of your units. It's going to affect the value based on those 30%, but everything else is going to go up faster.
Yeah, I noticed when my wife lived in New York City in 1973, and it wasn't cheap there then. So they've had rent control for most of our lives. So, alternate investments in real estate, alternative investments. So, are you doing anything in the area of alternative investments? I'm going to open it up to all of you, or are you staying in your lane?
I don't know what you mean by alternative.
I'm going to leave it open for interpretation. So, Damien, I'm going to start with you.
Yeah, so this has been a sweet spot for us for a couple of years now. We're big into the cannabis industry. The cannabis industry has a real challenge finding capital to support the industry because it's still not federally approved. So we found capital, and we found a fair amount of capital to go in and be the landlord for the cannabis industry. And our returns, we're buying at 14-15% returns in solid, good locations in California, Colorado, and Michigan. So we're starting off with 14-15% returns on our investment. and we're seeing rent growth, unbelievable rent growth. In Oakland, near downtown Oakland, we started with a building that was leasing up for an industrial building for 65 cents a foot, and we pushed the envelope, we thought, at 2 1/4. These are monthly rents. So 2 1/4 from 65 cents to 2 1/4, and the tenants paid for all the improvements. So we just bought the shell, put in the demising walls, and the tenants put in millions of dollars of improvements in the building, and they paid 2 1/4 starting off triple net rents. And today, within a little over a year, 18 months, we're now getting $3 a foot triple net on those rents in there. So we took a $10 million building, and theoretically today, if we were to sell it, it's probably worth around $24 to $26 million. So, and meanwhile, it's cash flowing. And we've replicated that in Colorado and now in Michigan. So the alternative investment market for us is the cannabis world, and it's been in my 40 years in the business, I've never seen this kind of an opportunity.
Nick,
You stole
alternative.
Stole from my mouth. That was it. It was the cannabis stuff.
So you're doing it as well?
Yeah, we did a little bit here, and then we invested with a guy up in the Sacramento area. But it's almost too good to be true.
Well, no.
You guys have any samples?
Yeah.
Gotta walk me to a barn.
Probably, yeah.
We need to make sure this isn't on video. No. All the cameras need stuff. Josh.
On the cannabis, is there any concern that there's artificial inflation based on speculation? And once things are regulated, it's going to drop through the roof?
Yeah, you have to expect that to happen. You plan for it to happen. And when you look at the price of cannabis in markets, when it starts off, when a state first approves it, I mean, values have dropped more than 50%. And so that has an impact on the whole industry. Certain industries, if you're in our buildings, in the beginning, we never bought a building that would have cultivating in the early stage of that state approved, because we know the cultivating prices are going to come down. But you think about cost of goods go down, who benefits from that? The manufacturers, the distributors, the oil companies, and all. They're the ones that benefit because their margins go up as the cost of the raw materials go down. So we were just in the secondary market, and we've shifted after a state stabilizes their price of the cannabis, the cultivating side. Then we jump in on that sector of the market, and once it's stabilized, and we feel that it'll either stabilize or go up from there. So you got to really watch the price of
So
the
you see it as more as a short-term opportunity or a long?
Yeah, I think. We talk about it internally. It's easily a 3 to 5 year play right now, and once the safe banking laws go into effect, and we're buying at cap rates that are unheard of in the real estate industry. Once the general public can get in and borrow from their local bank, then cap rates will come way down. And that's where we'll see rapid growth in our values. I mean, we're buying at double-digit cap rates, and if we can sell those, we're saying at 9 cap, reality, if somebody can borrow at 6 and buy your asset, why wouldn't they buy an asset that's well stabilized at a 7 or 8, which is still much higher than the average investment today yield. So we think there's a lot of upside, there's limited downside, and again, goes back to what I said earlier. You got to buy right, you got to have an end in mind. The end in mind when you buy, and you got to do your due diligence. So it doesn't mean you can just jump in and buy anything. We've seen people lose money doing what we're doing, so you still have to be careful in your due diligence.
Did he answer your question? Yeah. Yes, John.
So, David, you mentioned the banks. Is there some talk that they will be able to do that at some point? Or
yeah, it passed Congress already, the safe banking laws, but it's stalled in the Senate. So until the Senate passes it, and everybody thought maybe a year ago or 8-9 months ago or even less, they thought, okay, it went through Congress so easily that the Senate will pass it. And then impeachment proceedings started right about then, so everything came to a halt. Now, probably the best experts that I've heard and read about lately are saying it probably won't happen in 2020, but 2021, it's likely that it happen. It's just a matter of when, it's not if.
So I have a question for all of you. So an interesting thing that Chris said up front was barrier to entry. So, you know, to go and buy your own apartment building, right? For an 8-unit apartment building in San Diego, just an example, what would it cost to go buy that? Meaning, what would the sale price be right now for a C or D property?
If you just went to a City Heights, kind of middle of the row, $1,600,000, 200,000 a unit, probably fair.
So you need how much down to do that?
Yeah, half ones, half twos, and you're gonna be at like 30 to 35% down payment.
Okay, and then you need significant
half a
net
million
worth to
bucks.
qualify for the mortgage on that?
No, in commercial, it's more on the performance of the
Of
asset.
property, okay.
And then they just want to see any red flags of the borrower.
So if you want to invest $50,000 to $100,000 repetitively on a yearly basis, there are places like you all where people can go. Is that
If you have 50 or 100,000.
100,000? Do you syndicate?
Chris mentioned that there are groups out there that do that. I'm in a position where that's my next kind of step. So I'd like to take pooling money and then make it kind of more of a fair deal. There's a lot of fees and levels of stuff there.
Yep.
I'm not really that interested in that. I just want to control larger properties, and I can't afford those.
Yep.
So if anybody in here wants
Yeah.
to
Nick,
chat about that.
are you?
Yeah, I'm syndicating and I'm raising money for the deals that I have here in town, and they're typically short-term fast. I've done out of state. It's the distance for us. It's not feasible. And I didn't think it was, as I was talking to somebody earlier here today, you don't think that the deals are there, but like Chris was saying, 200,000 per door here in San Diego City Heights area is good. We're finding for like 160 a door, 170 a door. And that's our model. We just want to buy real good. I don't need to buy a bunch of properties, but the ones I buy, I want to make sure they do well. So
You're finding those in town.
yeah.
Damien, are you syndicating?
Yeah,
Taking
our
investments.
scope is a little different focus because of our advisory side of our company. And we're at any given time wrapping up close to 100 transactions, leases around the country at any given time. So we are tracking a lot of markets. And when we're in those markets, we're looking on behalf of our clients. When our clients pass on a good opportunity, we capitalize on it. So, you know, we buy a 1 million square foot warehouse in Fort Wayne, Indiana for $6.50 a foot. That costs $30 to $35 a foot to build. So we syndicate those, but we're quick to jump in and capitalize on those opportunities. And our knowledge is really nationwide, rather than we do very little in our backyard here. We're on planes every week.
Chris, are you more family office? Is that where you?
Yeah, so primarily we're managing the wealth of the families from the family office, but from time to time we will bring in other investors for individual deals or for to join us on one of our commingled funds. So they would get exposure kind of across a number of assets, a little bit of diversification, but we do that on a regular basis. We're doing a opportunity zone fund right now. $20 million that we're putting into projects across the country. So we've got one in Reno, we've got one in Salt Lake City.
Do you all know what opportunity zones are? Does anybody know? Okay, why don't you just, probably you and Damien probably know the most, I think.
Yeah. So opportunity zone legislation came through as part of the tax bill, Trump tax bill. So the opportunity zone, what it allows you to do is roll a gain from a previous investment. It doesn't have to be real estate, it can be a company you sold. Roll it into an opportunity zone fund, which then goes in and typically will go build real estate for the most part in designated opportunity zone areas. So we've got the projects, we've got our investors that have sold companies and rolled money in the projects. They get to defer their gain completely until 2026, and then they'll pay the gain on that investment.
And just your investments, where are these areas that you invested in?
So we've got one in Salt Lake City.
So Salt Lake City is a depressed, horrible economy, right?
Yes.
No, you gotta understand the law.
Yeah.
No, you gotta understand the law.
Yeah,
So every state in the country, the governors were asked,
Yep.
and the treasurers
to
were
designate,
asked to identify their underdeveloped areas and under economically developed areas.
Yep.
And designate 25% of those areas to opportunity zones. And that's how it comes about. So every city has.
sounds like a
area.
great opportunity.
It is.
It could be.
So I think it's around
Where
10%.
are your other ones that you've invested in this?
So Salt Lake City, Reno, Nevada, and then we've got a project in Philadelphia.
Wow, Damien, have you invested in any?
So no, we've underwritten quite a few,
Okay.
but we have not
Okay.
invested one yet, but we're tracking a lot of different markets around the country. And it's a good opportunity if you want a long-term hold.
Yep.
Yeah.
So it's
I'm sorry.
It's typically a 10-year play. So you'll put your money in, you get to defer your gain on so let's say so they use an example of you sold a Picasso. And, let's say in 2019 you sold a Picasso. You get to roll the gain from the Picasso into the Opportunity Zone Fund, which then you get to defer the gain on the Picasso until 2026. But on that Opportunity Zone investment, if you hold it for 10 years, you don't have to pay any capital gains tax on the gain on that investment. Federal capital gains tax.
You have to clarify California.
Still get the benefit of California, right? 13 points, whatever the
My
hell it is.
understanding is you have to put a lot of money in to develop.
Yeah, so that's typically,
20 or 30%.
you've got to double the basis of the project. So what that means is it's either got to be a really rundown industrial building or office building that you're putting a ton of money into, or you're developing ground up. So we're exclusively developing ground up right now. It makes the most sense. But the thing that's cool about it for us is you expect these areas to be super depressed. But when you pull up the Opportunity Zone map, and if you go to ArcGIS, they have their website has an interactive map of the whole country. You'll notice that there's some really, really interesting areas that you probably want to invest your money into anyway that are also opportunity zones. Like half of downtown Portland is an opportunity zone.
They were based on 2010 stats.
So I have a former business partner who did this in Orange County in what I consider to be one of the most expensive zip codes in the country. And he bought a building for his grandchildren. He redeveloped it into man caves. It was an old auto body shop. It was an auto body shop. So 1,000 square foot man caves, which were fully leased at 3 times the rent that was being charged on other commercial properties in the area. And he did it and deferred all the taxes from the sale again. So
That's a great idea.
yeah, you know what? It's a unique idea. So now he's looking at doing that in other locations, man caves, because people's houses and properties are smaller. So it's where you put your boat and your surfboards and your jet ski and your pool table and all the stuff you can't fit in your house now because you live in a 1,000 square foot house.
I have several.
concept.
I have several of these apartment buildings here in the Opportunity Zone.
Yep.
I'm not going in that route, but if I want to hang on to some of these, and then later on there's a fund that wants to pick it up, it's just another exit strategy. Keep the end in mind. Multiple exit strategies. So it's been a nice feature to have.
Eric, question.
No, I was just gonna make a quick comment. The thing about opportunity zones, as soon as the legislation, we own a very large opportunity zone up in Utah, west of the airport, that after we bought the property, got designated as opportunity zone. It was just a huge coup for us. But, the challenge you have is as soon as the legislation was announced, it didn't take long for the values to jump up almost immediately. So Damien's comment, and it's very much our viewpoint also, is you make your money on the buy, right? So you have to underwrite the property as if there is no opportunity zone benefit. And if it makes sense without it, then you can add in the benefits of what that means tax-wise afterwards. One thing that we purposely done is kept our fund very small because we don't want to have to place $100 million or $200 million. And I feel sorry for firms that have to do that now in this environment because they're going to have to buy a lot of really expensive properties to try to make it fit. We don't want to be in that position. We want to be nimble, quick, and be able to get in quickly and act with the smaller properties.
Opportunistic. Good. So I'm going to open it to the audience. Yes.
We defined what a 1031 exchange is, but I don't think we actually answered the question, which is when do you know when to buy
Good question.
or hold?
I was gonna get on for that.
Good. My fault. Can you come up here? Okay.
Cash flow is everything for me. So if I buy a deal, I want to know that I'm going to be making 5, 6, 7, hopefully more % return on equity. So what's that cash flow on the top line over the amount of equity in the deal? And if I hold that deal for 2, 3, 4, 5 years and the equity grows enough and the rents don't grow enough, typically that return on equity will drop. And if I maxed out and I kind of squeezed that orange or that lemon so much, at that point I'll either look at refinancing So if the rates are good, or I've got a good relationship with a bank or Sean Puckett right here, yeah.
It's a great relationship to have.
Yeah. So if there's an angle to do that, then I'll take the cash out and I'll take that and I'll go buy some more units with that cash. If the refinance angle isn't attractive enough, I'll put that place on the market and trade that and go into a 1031 and try to go up. I've learned a lot over the years from talking to bigger owners. It's all about number of doors long term. So if I can go from an 8-plex to a 12 or a 14 and kind of keep my cash flow, fairly close, maybe that takes a little drop for some amount of months, that in the long term is going to be a lot more advantageous.
I also heard one owner that during this last, market correction or change, they took all their B properties or C properties and upgraded to Bs on all their older properties that were going to need a lot of capital put into them. That you couldn't recoup the invest. They were kind of capped on where they could be in based on the market. They got rid of their Bs and bought, or Cs and got Bs. So, the classification moved up.
Really, if you see more opportunity somewhere else, I think that's when you should start thinking about 1031 exchange. If you're a value add guy and you come in and you put a bunch of money into a property, you juice rents by 20%, but then you've renovated all your units, there's no more upside for you in that property, then you trade into another property where you get the same thing. So that's kind of the idea behind hopefully 1031.
One more thing. I don't think about selling though when I purchase an asset. So it's like I only sell if the property is a pain in the butt. And I owned an asset down in Logan Heights. It was just like the management of it and overseeing it was not fun. And that was something I just said, screw it. And the cash flow was actually good on that property, but I didn't want to deal with it anymore. So I sold it and I went into a building up in Vista. So if the property's a pain, get rid of it. If it's not, it works, keep it. I think buying and holding long term is where the juice is, because that's where you're going to keep getting a lot of cash flow. And I've heard so many people that regret selling. It's crazy.
Damien.
Yeah, and 1031s, the biggest mistake I see people make is they don't plan ahead for them. And they find themselves in a time crunch, and they end up buying something they shouldn't have bought with the 1031 capital.
For more than they should pay for it.
Absolutely.
It's risky.
That happens
A
lot.
You're much better off just paying the taxes.
I agree with Eric. Sometimes you're better off paying, because if you get in a time crunch and you're doing anything you can just to avoid to pay those taxes, you're probably not buying right, which defeats the first principle of real estate. And so
you really need to identify your next buy before you sell the current one. Or
structure your sale so it gives you time, so you have extensions on that sale. So that if you don't find the asset in the time frame that you originally thought you could, you can put an extension in on your current sale and give you more time. You never want to go into real estate into a negotiation with your time constraint.
That's really wise what he just said about extensions.
Nick?
Yeah, so it's true. You definitely can get yourself in it. And I turn a lot of buildings, so I run into that issue quite often. But I think the thing that I do the best is just always having a deal lined up before that. And to also mitigate that, you can do a reverse 1031. So you can actually buy the property first and then sell your property later.
If you have some capital you're sitting.
Yeah.
Need the cash.
Or if you have a bank that understands reverse 1031.
Steve and Sean, I don't know. You guys want to arm wrestle?
Other questions? Yes, sir.
Any one of you acquired property going into auction, and what are the advantages, disadvantages of getting an invested property from auction?
There's not that many auctions. I mean, I'm just here locally again, but we're not seeing a lot of auction stuff now. A little after 2008 was great.
There was a lot of them in 08.
Yeah.
We sold
in 2000,
Yeah.
2008, 95.
Yeah.
I've gone through 3 or 4 of those cycles, and
We had
They have online auctions every year.
Yeah.
So
They have like LoopNet, and I mean, 10X is another one.
So we represented an owner of some retail property here in San Diego, and we just couldn't get our price. He wanted more. He was highly leveraged, and he was not cash flowing. So he asked us to try to sell it. We could not get his price. So we put it on 10X, and we got more than what we wanted for the property. So that auction actually got some bidding going, and the ultimate winner probably was a loser, in our opinion. I mean, it didn't make sense to pay.
So
what he was
I have a
paying.
question in relation to that. So I don't know if there are any of you, I don't call UTC a mall, I call it a restaurant row. But if you go to any of the other shopping centers in town, have you noticed a trend lately? Like a third of the doors are shuttered. So is commercial retail a good investment still? Is it going through a transformation? Is it dead? Is it, I mean, I don't know whether I'm overreacting or just seeing what I want to see.
It's a higher return, but it's more risk.
It's
You
a
gotta-
lot
you gotta
more
know
risk.
what you're doing.
Yeah, you gotta look at, I mean, how many of you now buy online? And so it is changing the industry. Retail isn't completely dead, but you better find a niche market that is always a stable asset, that has experience. I mean, the restaurants or theaters or something that brings people there, not just to buy widgets, but to go there for the experience. Otherwise, retail, we don't go into retail.
Do any of you go near retail?
Yeah, so we do some mixed use,
Okay.
primarily on the apartment side, and then we'll have some retail as a component of that.
So mixed use means 4 apartments and a store
We're
downstairs.
300 apartments. and,
Didn't you just
coffee
sell
shops.
a property that they're gonna do a restaurant downstairs? Or one of our members bought a property?
Right. No, if it's a mixed use, that's a different.
Okay.
It's not just strictly retail.
Yeah, what we found is that retail is concentrating.
Yeah.
So all the areas, B retail properties that are in kind of sleepy suburbs, they're not doing well anymore. California's a little bit different than a lot of other places in the country because they've restricted development so much that some of these locations are still doing okay. But if you go outside of California to areas like Salt Lake City, like Denver, and you go to these B and C centers, I mean, they're empty, and
Ghost towns.
all the good retailers within those centers have moved to better locations because even the good locations had tenants blow out. So you go to, and by my house in Irvine, we've got a retail center that is just like, you can't find a parking spot in there during lunchtime to save your life. I'd say 90% of the tenants in there are restaurants. So if you could be in a location where you've got a good surrounding population with some income, and you can be catered to that crowd for eating establishments, you're probably gonna be fine. But if you're outlying and you've got a shopping center with big blocks or kind of random inline retail, I'd be wary. And there's a lot of investors, and we have some of our clients that say, hey, I can buy this property at an 8 cap. It's like, well, it's gonna be a 4 cap in a couple of years.
Yeah.
Because you're gonna be losing tenants or your rents are gonna go down in concessions.
Dick, any?
It wasn't retail, but it was a restaurant, mixed use property, and
I saw that.
yeah, just gotta make sure you're stealing it. It's really gotta
Did
make.
you steal that?
Yeah, pretty much. It was great, and the seller actually did seller financing, and to someone's point with that question, it was they didn't manage it right, and they didn't have the capital to improve it, and we had the $400,000-$500,000 liquid to renovate it, and they offered us seller financing at like a 30-year fixed seller financing at like 4%. It was just. But again, it just came back to that. They didn't know where else to put their money. They didn't want to work to find.
And you
that
were in
deal.
front of them.
Yeah, and I was absolutely. Yeah, we were in front of them a lot.
It's opportunistic.
Yeah, absolutely.
So I've heard one of my mentors, Damien, I've heard the story of his first cold call in, was it Century City or?
Wasn't my first, but it's my blue shutters.
Yeah.
Right? Yeah. So you look for opportunities. I mean, we all drive by them every day. So I'll just be real brief on this. I was driving through Beverly Hills on Friday late afternoon, and I saw these blue shutters at the corner of Beverly and Wilshire. What landlord would allow their tenant to paint their shutters blue, especially at this location, this landmark location? So I said, well, I guess I'm not going home straight home. So I cold called the owner, and the owner that I thought I was cold calling was the building. He just owned the land underneath the building. The building was owned by Donald Sterling, and Donald Sterling was letting the building go dark because he was trying to squeeze out the ground lessor. And the ground lessor was the Louis B. Mayer Foundation. And I happened to cold call the nephew of Louis B. Mayer, who was overseeing that asset. And he said, "You got a lot of piss and vinegar in you, Damien?" And I said, "I haven't heard that term in a long time, but I'm tenacious." He said, "I'm tired of fighting with Donald Sterling." He goes, I will sell this land for you at the corner of Beverly and Wilshire for whatever you can get a loan for on it." I got a loan for $600,000. I bought the corner of Beverly and Wilshire for $600,000. How many real estate investors, brokers, drive down that street every day, have windows overlooking that building every day, and never stop to inquire what they could do with that?
Other
Just
questions?
Yeah, that's great.
Yes, sir.
Regarding multifamily, everyone talks about price per door and cap rate. Do you ever have clients that talk about like the gross rent multiplier?
Yeah. That's something that's kind of like fallen to the wayside. And I used to use it, and I still do. It's like a very good general gut feeling on the income on a deal. So 100%, I look for something that's going to be like sub 13, 12 and a half ideally. So yeah, GRM's great.
Other final questions? Yes, Tim.
What about, at least some things I've read is in the industrial space, with, say, Amazon next day, being able to service people, that Amazon doesn't have warehouses that provide everything. And what I've heard a lot is the industrial space is where you want to be, where the play is.
Last mile.
Yeah.
What did you say?
It's called the last mile.
These warehouses are being used to, you could be, say, a light bulbs, something that's really small but costs a lot. And you don't have a warehouse that can supply that. Let's say if you're in New York City, electricians fixing stuff, someone can just deliver the light bulb, but he's not getting in his car, driving to pick it up. But creating a whole new market for
it is spiking rents. We're negotiating on a 110,000 square foot building near LAX, and within a 5-mile radius, the population is something like 638,000 people, and these are fairly good demographics. And so we're talking to one of these well-known names that we toss around all the time for last mile delivery, and we're taking rents that are currently at 85 cents a foot in this building to $1.75 triple net. And because it's a great last mile delivery, it services West LA and into the South Bay. So rents are really spiking for those last mile deliveries. Amazon, Home Depot, Walmart, all the major distributors are looking for those locations that can service a densely populated area in a short
So
time.
Amazon, they never touch the product. When you buy something on Amazon, they have some kind of deal where someone else delivers it, right?
No, they'll actually, in the case of Amazon, they deliver. They want the whole vertical.
Yeah, but it's whole delivery companies that just serve Walmart.
Yeah.
Amazon is now outsourcing delivery.
Yeah,
There's
so
a lot of
it's
Amazon
not-
delivery trucks now
They
that
make
are
the
owned by
money,
private
they don't touch
parties.
the product.
Yeah. So, yes.
I'll quickly answer that. There's a property in La Mesa that I was in contract with, and it was a retail front, and there was a yoga studio, something else, and then the last unit we were actually negotiating with a representative from Amazon to put these storage lockers in there. Maybe you guys know about it. But basically they were gonna have the materials sent to the store, and then people could come to the store and pick it up.
And you enter a code, and by the way, I just picked something up yesterday at UCSD. There's a storage unit in the bookstore at UCSD. You order now, my iPhone case broke. I ordered now and it said, do you want to pick it up now at the UCSD warehouse? Because I guess that's a repetitive item. Or do you want to have it delivered tomorrow? And I said, I'll take it now. Went over and keyed in the code and walked away with it. That's amazing. Yes, sir.
I just have a last kind of food for thought for
Yep.
everybody to kind of think about. So we've watched these stock markets go crazy, since really 09, when we came out of the last big downturn. And if you think about it logically, demographics drive a lot of that. We have baby boomers that are feeding their retirement accounts at max rates right now, but now we're starting to see them exit the retirement force, which not only takes their contributions away from what's going into the market, but also they're flipping their portfolios from heavy equity to more income producing, which makes real estate become more attractive, by the way, over the next several years for many of those retirees. But for the stock market, we're headed into some interesting territory in that it's supply and demand on stocks, and you're gonna see the supply be pulled back as you see these baby boomers making the shift and moving more to income producing portfolios, which we prefer to use real estate or maybe private lending funds and other things that we utilize versus bonds, which are paying 1% or 2%, which doesn't make any sense. But you think about the effects it's going to have on the overall markets, it's going to be pretty dramatic The lucky thing the U.S. has that no other country in the world has is we have another generation coming up behind, Generation Y, that will hit their major income earning years at about 2030. And so we'll see a nice rebound, but it could be an
Plus they're gonna get all their parents'
2020s.
money. Yeah,
Yeah.
because they're gonna kill them
That's right.
early, so. they're-
Well, there's a lot of inheritance money, a lot of things coming around to them also, but the 2020s are gonna be kind of an interesting ride.
Sounds like a buying opportunity.
Sounds
At the
like
end
it.
of it. Yeah.
So, I want to thank you all, first of all, our panelists, thank you all for being so well prepared and sharing your time. Now, I want to allow you all some time to mingle with this group here, okay? So grab a coffee or a juice. We're going to end our program today. I want to thank you for coming, and I want to allow you time to speak to these four gentlemen. Thank you.